Ghana's gold revolution, how GoldBod strengthened the Cedi, and why the IMF is nervous. Africa's next growth wave. Welcome to Dr. Dan's channel. Today, we're talking about Ghana's gold revolution, how GoldBod and the Bank of Ghana used gold to stabilize the Cedi, build reserves, and challenge the IMF narrative, and what this fight reveals about the next phase of Africa's economic rise. Because on the surface, this looks like a technical dispute. Spreadsheets, losses, and a number, $214 million. But under the surface, this is a battle over something far bigger. Who controls African resources? Who controls African policy? And who gets to define whether an African country is doing well or making a mistake? Let's walk through it carefully. And I mean carefully, because this story has three layers. Layer 1 is Ghana's real economic rebound. Layer 2 is the gold strategy that helped it happen. And Layer 3 is the IMF reaction. Not just what they said, but what their model rewards, what it punishes, and why that matters for the entire continent. Now, before we go any further, here's the central question I want you to keep in your head. If Ghana's gold strategy helps stabilize the currency, grow reserves, and reduce vulnerability, why does the global narrative keep trying to drag it back into the language of risk, mistakes, and losses? All right. Let's start from the beginning. First, the context. Africa's moment, and why Ghana matters now. For decades, Africa has been treated like a continent that must always be managed. Managed by lenders, managed by donors, managed by external experts who arrive with formulas that rarely fit local reality. But the numbers are changing. And so is the confidence. In the IMF's own regional projections, sub-Saharan Africa's growth is expected to rise from about 4.1% to about 4.3%, moving into the next year of their forecast horizon, while emerging and developing Asia cools slightly around the low 4% range. That shift isn't magic. It's coming from familiar engines. Commodity demand, rising regional trade, investment in energy and logistics, and the biggest long-term factor of all, demographics, a growing working-age population. But Africa's growth story always comes with a trap. Because growth can happen and ordinary people still feel poor. GDP can rise and the currency can still collapse. Exports can boom and the dollars can still leak out. That is the African paradox. And Ghana, right now, is one of the clearest case studies of a country trying to break it. Next, how Ghana became rich in gold, yet short of dollars. Ghana is one of Africa's biggest gold producers. So here's the obvious question. How does a country sitting on a mountain of gold end up choking on a shortage of dollars? Because that's what happened. The problem isn't that Ghana doesn't produce value. The problem is where the value goes. For years, large-scale gold production was dominated by multinational structures. Gold gets extracted, exported, refined elsewhere, sold elsewhere, and a big chunk of the foreign exchange stays outside the domestic system. Then you have small-scale mining. And in Ghana, small-scale mining is massive. But that market comes with a leak, smuggling. If gold is bought informally, transported across borders informally, and sold externally, that's not just illegal trade. That is foreign exchange bleeding. Every ounce smuggled out is dollars that never enter your reserves. And reserves, in a crisis, are oxygen. So when Ghana's currency began collapsing and inflation surged, Ghana had a familiar choice. Option A, borrow dollars, again under conditions. Option B, capture more of its own dollar-generating resources inside its own system, and Ghana chose option B. Now, the core idea, capture more of the dollar value. Here's the logic Ghana pursued. If small-scale miners sell gold to smugglers, the country loses. But if the state creates a legal, organized buyer that can purchase locally, then export officially, then the dollars flow into the system. That's the essence of the domestic gold purchase concept. And later, the institutional upgrade, GoldBod, the Ghana Gold Board. Public reporting outlined Ghana's plan to formalize and centralize purchases from small-scale miners through a new state body, aiming to reduce smuggling and strengthen official control over gold flows. So the goal wasn't profit like a private trader. The goal was control. Control over supply, control over documentation, control over pricing transparency, and most importantly, control over how much foreign exchange stays in Ghana. Now, keep that word, control. Because the entire IMF relationship with Africa has historically been about controlling policy space. And when African countries control a strategic resource pipeline, they reduce the leverage of lenders. That's when the tension begins. Next, the IMF's claim of about $214 million in losses. Now we hit the controversy. In Ghana's IMF program review, the IMF flagged losses linked to the gold for reserves operations, reported in public discussion as about $214 million within the first 9 months of 2025, driven by trading shortfalls and program-linked costs. And instantly, the story spread in a familiar way. Ghana tried something African. It failed. IMF was right. But here's the problem. Even many analysts who accept the IMF's technical right to raise a red flag still argue the IMF should have clearly emphasized that these kinds of figures are often provisional and sensitive to accounting treatment until audits and final reconciliation are completed, especially when the policy's objective is macro stability, not commercial profit. And Ghana's response, especially from GoldBod leadership, flips the entire story. Because GoldBod leadership didn't deny there are costs. They denied that the program should be framed as loss-making failure. Instead, they asked a different question. What were the benefits? Then, GoldBod's response: judge outcomes, not just accounting. According to figures publicly stated by GoldBod leadership, Ghana's gold operations under the program generated about $10.8 billion in foreign exchange inflows, also described as over $10 billion in other statements. Helped Ghana hit foreign reserve targets early, described as meeting a 2028 reserve target in 2025, 3 years ahead of time. Supported a major currency turnaround, the Cedi strengthening sharply, with retail and interbank rates moving dramatically, and contributed to a sharp reduction in Ghana's debt metrics in local currency terms, framed as helping reduce debt to GDP and easing external vulnerability. Now, before we dive into the numbers, it's essential to separate two things. First, the figures claimed by Ghana's leadership are just that, claims. They are provisional and require a thorough, independent audit to be fully verified. This is standard practice for any program of this scale, and it's the only way to move from internal assertions to universally accepted facts. Second, while the specific internal accounting is up for debate, the broader macroeconomic direction is not. Multiple independent sources and external reporting agencies confirm a significant positive shift for Ghana during this period. A stronger Cedi, higher foreign exchange reserves, and a substantial increase in the nation's gold holdings. For example, independent analysis showed that Ghana's central bank gold holdings rose dramatically. They surged from approximately 8.7 tons to nearly 31 tons by early 2025. To put that in perspective, the nation's official gold reserves more than tripled in a very short time frame. At the same time, external reports confirmed that Ghana's gross international reserves, its stockpile of foreign currency, stabilized at around $9.4 billion in early 2025, providing a much-needed buffer against external shocks. And perhaps most impressively, the Ghanaian Cedi, which had been under severe pressure, staged a remarkable comeback. It became one of the world's best-performing currencies, appreciating by roughly 40% against the dollar during the period covered by that reporting. So, even if you question the precise internal accounting figures, it's hard to debate the overall trend. Ghana's currency and reserve position improved sharply in the exact same period the gold program was active. This brings us to the critical point. The international financial institutions and Ghana are talking past each other because they are fundamentally measuring different things. What the reported loss likely reflects: an accounting translation gap. Now let's explain this like a normal human, not like a spreadsheet priest. GoldBod leadership and supporting commentators maintain the reported loss is not theft or vanished cash. They attribute it mainly to program operating costs and, above all, an exchange rate translation gap. Here's the simplified mechanism they describe. Imagine the central bank buys an ounce of gold when the exchange rate is, say, 14 cedis to the dollar. At that moment, the gold is worth a certain amount in local currency on their books, but the entire point of the program was to strengthen the Cedi. As the program succeeds, the Cedi strengthens to, for example, 10 cedis to the dollar. The gold is still an ounce of gold, and its value in dollars hasn't changed. But when you translate its value back into the now stronger local currency, it's worth fewer cedis than when it was purchased. This creates a paper loss on the balance sheet. The asset didn't shrink, the measuring stick, the Cedi, got stronger. They argue this accounting gap explains roughly 97% of the headline figure, with the remainder reflecting competitive discounts to outcompete smugglers, processing fees, and minor assay differences. So from Ghana's perspective, the story is one of strategic investment. They're saying, we knowingly paid a calculated cost to achieve 3 critical national objectives: defeat smuggling, keep our gold inside the official system, and pull desperately needed US dollars into our national reserves to stabilize our economy. From the perspective of international financial bodies, the worry is different. They see these as quasi-fiscal costs, expenses that function like government spending but are run through the central bank. Their concern is that such activities can distort the central bank's balance sheet, hide underlying liabilities, and set a risky precedent. And here's what makes this situation so politically explosive. Both arguments can be partly true at the same time. A central bank can execute a nationally beneficial policy that also happens to create accounting results that international partners find concerning. This is why the real fight isn't just about whether a number is right or wrong. The real fight is about who gets to define success. Is it defined by a clean, conventional balance sheet? Or is it defined by national economic survival and a stronger, more resilient currency? Why institutions grow uneasy when policy independence expands? To understand the tension, you have to see the International Monetary Fund for what it is. Historically, it's not just a lender of last resort, it's a policy referee. And when a country borrows from the fund, it doesn't just borrow money, it borrows a framework. the IMF's specific definition of economic discipline, this isn't a gentle suggestion, it's a set of conditions, often called conditionalities, that a country must adopt. These can dictate everything from a nation's budget deficits and interest rates to the structure of its public sector. It's a complete economic blueprint handed over with the loan. Now, to be fair, the official argument for this is compelling. The fund will tell you that its framework prevents chaos. It stops runaway government spending, it halts currency collapse, and it tames hyperinflation. And in moments of acute crisis, there is evidence that this intervention can pull an economy back from the brink. It can restore a baseline of order where there was none. But in Africa, the relationship has a much deeper, more complicated history. A history that many critics describe as a modern form of economic control. Across decades of structural adjustment programs, countless scholars and even other global institutions have argued that this conditionality often pushed African states toward a very specific, one-size-fits-all policy mix. Severe austerity, rapid privatization of state assets, and the shrinking of their own policy space. These reforms sometimes stabilized the top-line macroeconomic numbers, but often at a devastating social cost, weakening public services like healthcare and education, hollowing out industrial capacity, and removing the flexibility for governments to support their own local development. In fact, independent analysis from other international bodies has repeatedly warned that aggressive austerity strategies can undermine long-term development goals. This is especially true in lower-income countries, where cutting public spending directly hits human capital and future productivity. When you cut education budgets, you're not just saving money today, you're sacrificing the skilled workforce of tomorrow. So, when you hear the term neo-colonial economics, this is the pattern people are often pointing to. It's a cycle with 4 distinct stages. First, African states are encouraged to focus on exporting raw materials, like cocoa or bauxite, instead of building industries to process them. Second, they are discouraged from using strategic industrial policy, the very tools that Western nations and Asian tigers use to build their own wealth. Third, they are pressured to keep their markets wide open, even when their new domestic firms are too weak to compete with established global giants. And finally, this combination often pushes them into recurring debt cycles, which ultimately restore the lender's leverage and begin the process all over again. Now, does the fund's board sit in a room and say, "Let's keep Africa dependent"? Of course not. That's a caricature. It's not how institutional power works in the real world. Power is far more subtle. It's embedded in the system's DNA. The fund's orthodox playbook, its core economic ideology, can produce outcomes that functionally keep dependency alive, even if the entire process is framed in the neutral language of stability and sound fiscal management. The road to dependency can be paved with good intentions, and that is precisely why a program like Gold for Oil triggers such deep institutional anxiety. Because gold isn't just another commodity. Gold is leverage. Gold is a universal reserve asset, recognized by every central bank on Earth. It represents the ability to stabilize your currency and pay for critical imports without having to ask for dollars. It's a path to solving your own problems. If Ghana proves this model works, that a nation can use its own natural resources to bypass the traditional gatekeepers of global finance, other countries will inevitably copy it. And if other countries copy it, the fund's primary source of leverage weakens, not because the IMF is evil, but because its influence fundamentally depends on states needing its particular brand of oxygen. Gold for oil offers an alternative air supply. That is the structural tension at the heart of this entire story. The deeper geopolitical context as China's growth moderates. Now here's where the global context matters. Asia's growth for decades was turbocharged by China's expansion. But even the IMF's tables show China's growth moderating compared to its historical highs. China is dealing with demographic aging, property sector stress, and the reality that once you've built highways, ports, and megacities, you can't repeat the same miracle forever at the same speed. Meanwhile, Africa is entering its late catch-up phase, where even moderate institutional improvements can produce large percentage gains because the baseline is still developing. That doesn't mean Africa is guaranteed an Asian-style miracle. It means Africa is entering a moment where global investors are forced to diversify, commodity demand remains strategic, and population dynamics favor labor supply growth. But there's a catch, and this is crucial. Africa can grow 4% and still feel like nothing is happening if per capita gains are weak and value leaks out. Which is why Ghana's experiment matters. Because Ghana is attempting something Africa has talked about for decades. Stop being a passive exporter of raw resources. Start capturing the financial architecture around the resource. That's a different level of sovereignty. The real debate, textbook economics versus survival economics. Let's name it plainly. The IMF operates on textbook economics. Central banks should not run quasi-fiscal operations. Interventions should be transparent in budgets. Price mechanisms should be as market-based as possible. Avoid distortions. Avoid hidden liabilities. Ghana is operating on survival economics. Stop smuggling, or you lose the dollars. Stabilize the currency, or inflation destroys purchasing power. Build reserves, or a shock knocks you flat. Keep the system formalized, or you bleed quietly. So Ghana is saying, yes, there are costs, but the costs bought us stability. And then comes the most dangerous phrase in global finance. It worked. Because if it worked, then the question becomes, why wasn't Africa encouraged to do more of this earlier? And that's exactly why this story spreads as controversy instead of case study. What Ghana must do next to win the argument. Now here's where I'm going to be very direct. If Ghana wants this model to become a continental blueprint, Ghana has to do something more powerful than speeches. It must prove discipline. Because the loudest criticism, even from African voices, is valid. State control collapses when it becomes a political cash machine. If GoldBod becomes opaque, party-controlled, unaudited, used for election financing, riddled with sweetheart contracts, then Ghana will hand the IMF and the West the perfect weapon. You see, we warned you. Governance. So the winning strategy is simple. Not easy, but simple. Publish gold purchase volumes regularly. Publish export receipts regularly. Use independent audits with credibility. Create parliamentary oversight with teeth. Keep reserve building boring, not propagandized. Because sovereignty isn't noise. Sovereignty is systems. And if Ghana builds systems, Ghana doesn't just win this argument. Ghana rewrites the African playbook. Why this matters beyond Ghana? This is bigger than Ghana. Because Africa's biggest economic weakness isn't lack of resources. It's the structure of extraction. It's the pipeline. Resource out, value out, dollars out, debt in, conditions in, policy space shrinks. GoldBod is one attempt to flip that pipeline. Resource captured, exported formally, dollars in, reserves up, currency stabilizes, policy space expands. If Ghana can do it with gold, other countries will ask, can we do it with copper, lithium, cobalt, oil, cocoa, rare earths? And that is exactly why this story is being fought so aggressively in narrative space. Because controlling the narrative is the first step to controlling the policy. Final take. Ghana's gold is a referendum on Africa's future. So, when you hear $214 million losses, don't stop at the headline. That figure, taken in isolation, is designed to provoke a reaction, not to inform. It's a snapshot without context, a single data point in a much larger, more dynamic picture of a country fighting for its economic life. You have to ask, losses compared to what objective? If the objective is short-term commercial profit, then yes, you'll frame costs as failure. A corporate trader would look at this and see only red ink. But a central bank isn't a hedge fund. Its mandate is not to generate profit. It is to secure the stability and prosperity of an entire nation. But if the objective is to build a resilient national economy, then the calculus changes entirely. If the goal is to stabilize the currency, protecting citizens from runaway inflation, stop the billions lost to gold smuggling each year, increase national reserves to buffer against global shocks, reduce the crippling vulnerability to foreign exchange volatility, and ultimately exit dependency with the leverage to chart your own course. Then the real question is not, did it cost something? The real question is, was it worth it? Was the price paid a worthy investment in a more stable, independent future? And if Ghana's leadership claims the inflows were $10.8 billion, the currency strengthened dramatically, reserves surged, and targets were hit early, then Ghana is telling the world, we're not begging anymore, we're building. It's a declaration that they are willing to absorb a calculated short-term cost for a priceless long-term gain: control. Now, external financial bodies can respond with caution, and some of that caution may be technically reasonable from a risk management perspective. Their models are built on predictability and standardized rules, but Ghana's pushback is about something deeper, something structural. We will not be managed forever. It's a nation saying, your rulebook was not written for our liberation. That is why this fight matters beyond Ghana's borders, because the future of Africa's growth is not just about GDP percentages or export volumes. It's about whether African countries can build the institutions that capture value at the source, hold their own reserves, stabilize their own currencies, and finally, negotiate as equals on the world stage. Imagine a Zambia that leverages its copper this way, or a DRC that controls its cobalt, or a Côte d'Ivoire that monetizes its cocoa. That's the gold revolution. And if Ghana gets it right, it won't just be Ghana's story. It will be Africa's blueprint. If you want more deep dives like this, where we break down the numbers and the power behind the numbers, subscribe to Dr. Dan's channel. We believe in going beyond the headlines to understand the structural forces shaping our world. And tell me in the comments, do you see gold for oil as a necessary step towards economic liberation, or a risky, unconventional experiment that could backfire? What would you do? Let's discuss.